Good morning, students. This is chapter number 2, Accounting for Not-for-Profit Organizations. In this chapter, we will be talking about different categories of not-for-profit organizations, and then we will look into the accounting rules of these organizations, and we will also have some examples to work with. Starting with the characteristics and are followed by categories of not-for-profit organizations. So firstly, let's talk about their characteristics. Not-for-profit organizations, the first characteristics is that they get contributions. The contributions are the major source of getting the revenue, and they don't expect any, the revenue provider, the contribution maker does not expect any commensurate returns on it. He does not want anything as a return. The purpose of these organizations is not to sell the goods and services for the profit's sake. The purpose is other, like social or goodwill purpose. Moving on towards the third characteristics, they lack ownership interest. When I say they lack ownership interest, it means that owners does not want return from this organization. Like in normal organization, owners equity represents what stake they have in the company. But for not-for-profit organizations, owners does not want any share in the assets of the company. Usually we have two categories of not-for-profit organizations. One is government and the other one is non-governmental. Those not-for-profit organizations who are governmental, they follow the rules made by GASP. GASP means Government Accounting Standard Board, and not non-governmental not-for-profit organizations follows rules which are made by FASB and presented under GAAP. Let's talk about the categories of not-for-profit organizations. So they have multiple categories, starting with voluntary health and welfare organizations. This is one of the main category for which we have many cases to discuss in this chapter. Then we have hospitals and healthcare organizations which are working for not-for-profit. Colleges and universities also. Some colleges, they are private and they earn profit. I'm not talking about them. I'm talking about those colleges and universities who are for the social welfare. And then some other not-for-profit organizations could be churches, museums, and any other, organization whose job is to serve the community. They say that many other not-for-profit organizations which exist, their accounting is similar to the first category which we discussed, voluntary health and welfare organization. They are similar to them. But one thing which these organizations does not make to do these other organizations, that voluntary health and welfare organizations are required to submit statement of functional expenses, which is not required, or you can say which is not must from the other organizations. Let's talk about government and non-government not-for-profit organization. Starting with governmental not-for-profit organizations, these organizations have the officers which are elected or appointed by the government. That's why they are governmental not-for-profit organizations. Government has a sole or unilateral control to dissolve these organizations, and after dissolving or finishing or closing these organizations, all the assets of these organizations will be returned back to government. And government can enact or enforce the taxes on these organizations since they are governmental not-for-profit organizations, so they follow GASP. Moving on towards non-governmental non-for-profit organizations, so they follow FASB, and FASB has different set of statements which are required by these organizations and the set of their financial statements as well, which I'm going to discuss with you in the coming learning objective. That is accounting principles. Starting with the types of financial statements which these organizations are required to prepare. Statement of financial position is the first position. You know that this is balance sheet. Then we have statement of activities. It's similar to income statement. And in case of hospitals and healthcare organizations, there this statement of activities is replaced by two other statements, which is known as statement of operations and statement of change in net assets. Then they also prepare the statement of cash flow, all these organizations. And a few minutes before I mentioned that statement of functional expenses is typically required from voluntary health and welfare organizations, but it's not must for others. The first financial statement, which is statement of financial position, means balance sheet. This is also known as balance sheet, and it reports assets, it reports liabilities, and as I said that the owners does not have equity claims on this, so we don't mention equity. Instead of that, we mention net assets. Net assets are assets minus liabilities. It reports net assets in total, means the full net assets, and when they're mentioning the total net assets, they are mentioning them under three categories. What are those three categories? They are known as unrestricted net assets, temporarily restricted, and permanently restricted. Permanently and temporarily restricted amounts, they appears on the balance sheet, or sometimes they can appear in notes to financial statements as well. When the donor they provides the assets to the organization, they might impose the restrictions on the use of these assets. Like for example, a client has, or you can say a donor has provided one of the X-ray machine to a hospital, and they want these X-ray machines to be used by only a specific category of patients, not with for everyone. So he is imposing a restriction which has a purpose, that the machine should be used only for a particular purpose. So he's imposing a restriction, and this restriction limits the use of this asset. So that's why these assets should be separated from those assets which are easily available for use. They are not restricted. So unrestricted should be separated from the restricted assets. In normal companies, when you download their financial statements, you find that 2 years or 3 years financial statements are available. Let's suppose if you download the financial statements of 2023, you find that 2022 and sometimes 2021 financials are also there. So these are known as comparative financial statements, which is not required in case of not-for-profit organizations. Moving on towards different classes of assets which are there in a statement of financial positions. So we have firstly permanently restricted net assets. Permanently restricted net assets are those assets on which the donor he impose a restriction, and that restriction is not going to expire. It's forever. He didn't say for 6 months or 5 months. He said forever use this X-ray machine for a particular purpose only. So with the passage of time or with the completion of action, this restriction will not be removed. That's why we say these assets are permanently restricted. What if the restriction is temporary? For example, there is you can say a temporary camp for a purpose of, let's suppose, providing healthcare services to the flood victims, or you can say those people who are suffering from the disasters of the flood. A healthcare camp has been made for them, and a donor has provided, and let's suppose that healthcare camp is by made from an hospital, or a hospital has started that health camp. So maybe a donor is donating let's suppose few beds for this camp, and he says that once the camp is over, you can use these beds in your hospitals, but until the camp is there, these beds are for this healthcare camp only. So he's putting a restriction which will be over when the camp will be over, right? So this is temporary restriction, and it's because of a purpose, that when the purpose is over, it's going to be removed. We could have time restrictions as well, that he says that for 6 months use these beds in this camp, and after that you can use it in your hospital. So 6 months is a time restriction. So donor can impose the time restriction. He can also impose the purpose restriction, and when these restrictions are over, or these are met, or they expire, then after that the asset is no more temporarily restricted, it's an unrestricted assets. Sometimes donors provide straightforward unrestricted assets, that use these assets as you like. So we have three categories of assets. Let's talk about statements of activities. The statements of activities provides the information about the change of what? In the amount and the nature of net assets. Like nature, I explained few minutes back that the asset was temporarily restricted, and once the time is over or the purpose is accomplished, it becomes unrestricted. So this is the nature which is changing. Amount, we have few some items, some inventory items with us, and we use them. These inventory items were provided by a donor, so the amount is now reduced as compared to before, or some new amounts, some new stuff came to the this organization, so the amounts can also change. So statement of activities shows us the change in amount and the nature of assets, and reports how the resources are used to provide the various programs and services. If different services are provided, how these resources were utilized for them. So in this statement, the change in the net assets is shown separately. Unrestricted asset changes is shown separately. Temporary and permanently restricted assets changes are also shown separately. Revenues and contributions are shown in all the three categories. Now, when a contribution or a donation is made by a donor, or this organization gets a revenue, we don't put straightforward revenue like in normal companies. No, we put revenue or the contribution from unrestricted, assets, or contribution in form of restricted asset. Like that, we have to mention in three categories. But when it comes to the expenses, they are only shown in unrestricted assets category. We already talked about reclassification. Reclassification means that temporary restricted assets are moved to unrestricted assets when the time is over or the purpose is fulfilled. What about statement of functional expenses? So voluntary health and welfare organizations must report expenses, and they should report them according to the functions which they have performed. And also under those functions, they have to mention them according to their natural classifications. That is it salary expense, is it rent expense, is it insurance, what is this? Other not-for-profit organizations are not required to prepare a statement of functional expenses, but yes, they are encouraged to prepare it. Now let's talk about the source of revenue for these organizations, that is known as revenue, or sometimes we call it as contribution as well, because donors contribute in these organizations. So for non-profit organizations, contributions are the major source of revenue. Now we need to know what is contribution. Contribution could be in any form, like a third party who is not from this organization, he's someone else. He is transferring unconditional cash. He's just giving a cash without any reason. He's just saying that this is for your organization, please use it for the operations. So it's unconditional transfer of cash. Or he can also provide some assets in form of building or in form of equipment, usually in form of equipment, to an entity. Who is entity? For our case, it's non-profit, not-for-profit organizations. Or he can settle. Settle means pay the liability of this organization. This organization has a liability and a third party came and he said, I'll pay for you. Or cancels of its liabilities. What does cancellation means? This not-for-profit organization has to pay some money to this donor. Donor says, I cancel this liability. You don't need to pay me. In a voluntary, the donor does it voluntarily. It's non-reciprocal transfer. Non-reciprocal means he does not want anything in return. By another entity. Who is another entity? He is neutral. Donor is neutral. He is not from not-for-profit organizations. So he is other than the owners of these organizations. What does he provide? The other assets could be in form of building, in form of securities. He can give his building for a specific purpose that you can use it for your, the building belongs to a donor and he is giving it for free schooling. He is not charging the rent. And also contributions includes unconditional promises to give. The organization have not received the money yet or contribution yet, but the donor has made a promise that he will give, and it's unconditional without putting any condition on it. So these are all the categories, or you can say the examples of contributions which could be made by the donor. There is another concept which is known as promise to give. We just talked about unconditional promise to give is an example of contribution. What about conditional promise to give? So before talking about that, let's see what is promise to give. So it's a return or an oral agreement to contribute that I will contribute. He's promising a cash contribute that I will contribute. He's promising a cash or some other form of assets to this not-for-profit organization. The promise should be verified. Now, how do we know that it's a promise? Because we have an evidence for this. So, which kind of evidence? Maybe a card or a written note is given, or a tape recording is available for the oral promises. So, the promise could be conditional or it could be unconditional. What is conditional promise to give? Do remember, unconditional promise to give is a contribution. We just took it in the definition. Let's talk about conditional promise to give. It depends on occurrence of a specific future and uncertain event to bind the promiser. Like he says that the donor says that if you do this task in the future, I'm gonna contribute. For example, a church parishioner may pledge to contribute a sum of money if a local government approves a proposed church renovation. Let's take another example. A donor says that I will contribute if the government approves the renovation of this welfare school or welfare dispensary. So if the approval will be there by the government, then he will contribute. So it's a conditional promise. Organization, now how to record it? So not-for-profit organizations, they recognize conditional promise to give as a contribution revenue, and they say it's a revenue, but it's receivable when but not immediately, like as soon as the promise is made, means conditional promise is made, they will record it. No, they will wait. Can you see here? When the conditions are substantially met. They say that as soon as, in my example, government approves the renovation, the not-for-profit organizations are going to record this conditional promise to give as contribution revenue, and they will not debit cash because they did not receive it yet. They will say this is this is promise receivable. So they will debit receivables and they will credit contribution revenue. Sometimes the donor gives the money in advance. He says that this is gift or this is a cash for this particular purpose. So if they get a conditional for a purpose, conditional gifts or cash other than the assets, then and if the purpose is not going, means if the condition is not going to met, they have to return these assets to the donor back. So this is something like earned revenue. Remember what is unearned revenue? You receive the money in advance, and if you don't fulfill the condition, you don't fulfill the sales, then you have to return that money. So that's why you have a doubt that these donations would be returned back, these gifts would be returned back. That's why you call them as refundable advances, means they are liability for you, and you already received them, so you debit cash or whatever asset you have received. You will not debit receivable because you received them in advance. Moving on towards unconditional promise to give. So unconditional promise to give only, it's because it's a promise, so we need to wait for the time to pass and then we will get the money. So it's just pending because the passage of time, we need to wait for the time. So as soon as an unconditional promise is done, we will record it as a contribution revenue, and it will be receivable because after some time it will be collected. Generally, not-for-profit organization measures restricted and unrestricted contributions at their fair value. These contributions, conditional or unconditional, they calculate them at their fair value, and they recognize them as revenue or gain in the period in which they receive them. Okay. Also, the contributions have these categories based on the classes of assets. We already talked about it, that contributions could have donors imposed restrictions. Time restrictions could be there, or the permanent purpose restriction could be there. Restrictions could be temporary, restrictions could be permanent. Okay. When the temporary restrictions are met, reclassify temporary, so it was temporary restriction, so we have to reclassify these temporary restricted assets to unrestricted assets. Gift of long-lived assets. You can also receive the long-lived assets as gifts from the donors. So they are usually unrestricted, but if the donor imposed the temporary restriction on them, so they are going to be listed under the temporary restricted net assets. So we have talked about contributions, which are the major source of revenue for not-for-profit organizations. And we also talked about promises and gift in kind, that when they become contributions for us. For promises, we talked about conditional and unconditional promises. Now, what are those things which are not considered as contribution? So they are known as transfers. Transfers are also known as non-contributions. What does transfer includes? Transfer includes exchange transactions. Transfer includes agency transactions. Transfer includes possible gift in kind, possibly. So let's talk about transfers that are exchange transactions. Um, what is an exchange transaction? As its name says, that give and take. Okay, so in which in these transactions, both parties gives and receives approximately equal values. Like, let's suppose one party is giving a gift, other party is contribution a cash, but the value of the gift is exactly the same as the value of the cash. So it's a exchange transactions. So sometimes, it becomes difficult to identify, is it an exchange transaction or is it a contribution? So we have an example over here. Assume not-for-profit organization sends calendars to the potential, means possible donors, in a fundraising appeal. The recipients, the people who are receiving these calendars, they keep these calendars with them, or the premium. The calendar means it's a type of premium which companies, these not-for-profit organizations gives. So they keep it, but it's up to you. They might give the donation, they might not. So in this case, the donation that results from the calendar mailing are contribution. And so if the donor gives the money which is more than this the amount of this calendar, because a calendar doesn't cost much for printing, right? So if he receives one calendar, but as a result he is giving $1,000 of donation, so that's a contribution because it's not equal amount. And for printing these calendars, whatever cost was as a whole, we call it as cost of premium, okay, because it's a result of fundraising expense. But if the donor receives a gift from this not-for-profit organization, let's suppose not-for-profit organization is sending a kit, a table kit for one of the possible donor, that includes the calendar, the pen, and the writing pad, and some more stuff in this. And the cost of that gift is, let's suppose, $500, and then the donor also gave a donation of $500, so they both are equal. So it's not a contribution, it is known as an exchange transaction. Resources receives in, but you are receiving something and you are giving something, right? So what you are receiving, this $500, you need to classify it as unrestricted revenue and unrestricted net assets. Why? Because what you get, exactly the same you have already given. So donor have no right to impose a restriction on it, right? So that's why we do not classify it as restricted. We classify it as unrestricted revenue and unrestricted net assets. Even if the donor says no, this is the limit on it, we will not listen because we have already given him the same amount of premium. Moving on towards the second category, in which these not-for-profit organizations works as agents, or you can say as agency services provider. So in an agency, transactions is one in which assets are transferred to not-for-profit organization, but not-for-profit organization has little or no discretion over the use of those assets, and the assets are passed to a third party. Let's take the example of a flood camp. The one community, they have provided some some clothes or some food items to a not-for-profit organization, just because the not-for-profit organization is working in that flood area, and they say that give these things exactly the same to the flood victims. So in that case, this not-for-profit organization is only working as an agent, because they cannot use these things anywhere else. They have to take and then give it to the third party, which is flood victim. The resources provided in provider means people in is using the not-for-profit entity as an agent or as intermediary party to transfer the assets to the third party. We have another example. For example, United Way often acts as an agent by collecting contributions for distribution for a number of local organizations. Under GAAP, the receipt of assets in an agency transaction increases the assets as well as the liability for the not-for-profit organization. Why? Because as soon as they receive the assets, these assets are liability on them that they have to give it to the third party. So assets will be recorded, but similar accounts, liabilities will be recorded as well. And when they disperse these assets, so in that case, assets will be decreased and the liability will also decrease. During this process, we will not record any revenue or program expenses. The not-for-profit agent reports the cash receipts and paid as cash flows from operating activities in the statement of cash flow. If he is getting the money from the donors, which he has to give to the third party, so he will put it in the cash received, and when it will be paid, he will put it as cash paid in cash flow statement. At the same time, it will also appear in the cash side of the asset side and in the cash, and in the liability side, he has to mention it as a payable. The third type of non-contribution is known as gift in kind. Gift in kind are non-cash contributions such as clothing, furniture, and services. And they are contribution, they will be considered as contribution if not-for-profit entity has a control over their use. Not-for-profit entity can dispose them or you can use them according to their own will. If they don't have control over their use, then they will be accounting them as a gift, as agency transaction. Organizations measures gifts now in order to record. Now see, can you see they are not cash, they are clothing, they are furniture or the services. So how to record them in the book? So the not-for-profit organization measures their fair value if it is possible. If the fair value they cannot measure, then not-for-profit organization will not record them as contribution. Instead, they will record the item as a sales revenue when they sell them. Cost of sale is a cost of getting the inventory ready for sale. So when they get these items, they cannot record them as a contribution or sales, but when they give it to, if they sell them, then they get the money. That money is going to be recorded as revenue. So we have classified those items which cannot be considered as revenue. Now let's apply these theoretical explanations into voluntary health and welfare organizations' practical application. Starting with this example, voluntary health and welfare organization VHWO. This category has one organization, for example, its name is NHN. This is the name of the organization working under the category of voluntary health and welfare organization. As part of its fundraising efforts in 2016, NHN distributed decals to all the residents in the community. So they have distributed decals to everyone. Decals cost NHN $145. They have distributed decals to everyone. Decals cost NHN $145. So 145 was the expense in the making or for these decals. As a result of this fundraising campaign, the organization receives unrestricted cash contribution. This is revenue, but it's in form of cash. How much? 4,000. So they get contribution revenue and they get cash. So cash debit, contribution revenue gets credit, and it's unrestricted. So I need to classify it, right? So I'll say unrestricted contribution, or you can say unrestricted contribution, support contribution. And also what they receive, an unconditional promise to give. Remember, unconditional promise to give, what did we say? It's a contribution receivable, right? And we record it as our revenue, contribution revenue. So the amount was 6,000. So contribution receivable is 6,000. Let's see, what should I credit? Is it unrestricted or restricted? Of this 6,000 contribution receivable, 2,000 is not collectible until 2017. a presumption exists that this 2000 due in 2017 is restricted for use in 2017. So can you see now this 2000 which is receivable in 2017, that has a time restriction, and once the time will over it will become unrestricted. So I get temporary restricted contribution of 2000 out of 6000, right? And remaining 4000 out of 6000 is unrestricted. But there is something else, because these are receivables, so we might have allowances for doubtful, right? Or uncollectibles. So let's see. NHN estimates that 10% of these promises or pledges will be uncollectible. So it means that total promises were 6,000. Out of this, we expect 10% will be uncollectible. So that's an allowance. Remaining, are having two categories. We have unrestricted revenue or contribution, and we have restricted. This is 4,000 is unrestricted, and 2,000 is restricted, temporary restricted contribution. So let's make these journal entries. Firstly, for decals printing, we have an expense of 145. So you debit expense. You can debit expense fundraising. You can debit expense sporting services. It's up to you, but you need to write the category why this expense is there. 145, and cash gets credit. Then you receive 4,000 cash contributions, which are completely unrestricted. So cash gets debit, unrestricted support contribution. This is a type of revenue, gets credit, 4,000, 4,000. $6,000 of unconditional promises. So that is contribution receivable, 6,000. But 10% we expect that this is allowances for, in normal accounting we say allowances for doubtful accounts, right? But we don't have doubtful accounts, we have contribution. So we will say allowances for uncollectible contribution, 10%. So that's 600. Now if you remember, out of 6,000, 4,000 was I'm writing 4K, okay? 4,000 was unrestricted and 2,000 was restricted, right? Temporary restricted because of time. But we have created this allowance, so we will take out the 10% out of it, so that will be 400. So remaining 3,600 is recorded here, and this is 2,000. 10% is already reported here, right? So 2,000 minus 200, which is 10%, we get 1,800 over here. Like this, you need to do the calculations. Let's see what happened next. NHN collected 3,600, this one, 3,600 of the contribution receivable due in 2016, and wrote off remaining 400 as uncollectible. If you remember, the full amount was 4,000. Out of 4,000 was receivable, but out of this 400 we have already created an allowance. They said that was not collected, so now remove that allowance. So we have collected the cash of 3,600, allowance gets debit 400, and contribution receivable 4,000 was removed by crediting it. Remaining, how much receivables are there? The total is 2,000, but out of that 1,800 is in the revenue account, and we have already out of 2,000, the 200 are still in allowances account. So let's see what happened with them. Assume NHN collects the full 2,000 due in 2017 during that year. So we assume that it will be 1,800, right? And but actually we have collected full 2,000. So our cash will get debit because we have collected it. Allowances we have to remove from the books, right? Because no more receivables, we have to remove it. But contribution receivable was for 1,800. So because we have collected it, we are going to consider it as a gain or a revenue for us. So that's why we have credited unrestricted support contribution in form of a revenue, because we were thinking we will not be able to collect it, but we actually collected it. Now, if you see, because we get this money, it was temporarily restricted. Now we need to remove it from the temporary restriction, and we need to put it in the unrestricted net assets. So how I'm going to do that? Temporary restricted net assets will get debit. That was 1,800 because this what we have recorded, right? And unrestricted net assets are going to get credit. Moving on towards the next case, a donor gives NHN 1000 that is restricted for a playground project. So he imposed a purpose restriction. NHN purchases supplies for the playground project for $900 and reported the expenses as change in unrestricted net assets. So out of 1000, he has utilized 900 for the expenses, and these 900, because now it is used, they get the supplies, so now it is no more temporary restricted, it is unrestricted now. So how they are going to record the entry? The organization makes an entry to reclassify 900 as of temporary restricted assets. How does reclassification happens? The temporary restricted net assets goes to unrestricted net assets. So let's record whole scenario. They received cash of 1000 and it was temporary restricted contribution revenue. Then they have purchased $900 of supplies. So this is an expense for the program services, and cash gets credited because they have used it. Now the asset should be reclassified. So how I'm going to reclassify it? Only this 900. So temporary restricted net assets gets debit. It's out. I'm taking it out from it, and I'm putting in unrestricted net assets classification. Let's talk about donated long-lived assets. NHN has a policy of implying a time restriction on donated fixed assets over the life of each asset. They have a time restriction on it, and we talked about time restriction is a temporary restriction. On January 1st, 2016, Martin Construction donated a used van to the organization. So they need to estimate its fair value, right? So the fair value of the van is 1,500. It has a 3 years remaining useful life. The van will be used in the organization's community program, service program. NHN initially record this donated van as temporary restricted assets. Later on, NHN records the depreciation on the van as a program expense. The amount of the depreciation expense, because now out of the van value, we have taken out the depreciation. So now this part of depreciation expense, we are going to remove it from temporary restricted assets to unrestricted assets. Okay. So let's see its application. Firstly, they receive a van. Van is classified under equipment. So equipment gets debit. Fair value was 1,500 and it is temporary restricted contribution. Then they have recorded the depreciation expense of this van, that is 500, but you know this is expense because of the program services, and you can write here depreciation expense. And what is the formula for depreciation? What is the journal entry for depreciation? Depreciation expense gets debit, accumulated depreciation gets credit. So I have debited the expense and I'm going to credit accumulated depreciation. Now this 500, which is already recorded as expense, now this is no more temporary restricted. It should be taken out from the classification of temporary restricted, and we should put it in unrestricted net assets. So this in and out define from where you are taking it, where you are putting it. Let's talk about some further stuff, which is special event fundraising. A fundraising event on NHN featured a dinner and dance. Ticket sale from the dinners total 950. So 950 is the sale money which they get from the tickets, and expense of this event was 650. Voluntary healthcare organizations generally report gross revenues and expenses for these special events, not the regular one, special events related to the major ongoing activities in which attendee receives a benefits. If the special event is incidental to the activities of the organization, means it was not a regular one, it's a special event all of a sudden they have organized, it was not in their plan. So the organization will be recording whatever proceeds, whatever revenue they get from these special events as gains. Like it's not a contribution revenue, it's a gain, because this events as gains. Like it's not a contribution revenue, it's a gain, because this event was not in their annual plans. Okay, so how we're going to do that? They collected the money 950 and it's a gain, unrestricted gain. Okay. Then later on, what happened, the expense of this event was 650. So this expense is going to decrease the cash 650, and the gain is going to decrease now because we have utilized this ticket money. To remember, this is a special events. It's not the regular events. In regular events, we call it as contribution. Okay. Moving on towards the gift in kind. Throughout the summer, NHN receives donation of used housewares and furnitures that are then sold at our rummage sales held in August. So they collected different furniture and housewares. Fair value for the donated items cannot be reasonably determined. So we don't know the fair value of them, right? So we cannot record this amount as a contribution. But the cost of storing and moving the items to the remit sales location is 550. But we have items, if you remember gift in kind, I said that whatever cost you will incur to make these items saleable, that's cost of sale, right? So I'm debiting cost of sale 550, and cash gets credit because of course you pay the money to the transportation to take this furniture, so cash gets credit 550. Proceeds from the sales are 6,595 when this furniture was sold out. You have, um, you get the money of 6,595, so cash gets debit. I cannot say it's a contribution, it's from the sales, right? So this is revenue, or you can say unrestricted revenue, because we have to classify the revenue. So this is unrestricted revenue, 6,595. Moving on towards if the fair value you can determine, like in the previous case you cannot, but if you can, then how you are going to handle the case. Whatever fair value you can determine, that is recorded as contribution. Office Mate Company donates office supplies with a fair value of 390 to NHN. So what did they get? They get a contribution, unrestricted support contribution, and supplies. You can write office supplies, you can write material and supplies inventory, it's up to you. 390. Membership fees. Membership gives members certain benefits, such as right to receive organization newsletter or some, premium services. In cases in which the fair value of members' benefit is less than the amount of dues, like let's suppose a member pay $5,000, but the benefit which he receives that's only around $1,000, then what you do, these are non-profit organization divides the transfer between contribution and revenue. Like how much is the contribution and how much is the revenue. The extra which you get, that's a contribution. The regular is a source of revenue because you sell your membership. An organization may have different levels of memberships, but the more expensive memberships does not mean that the members are getting additional services. The excess payments which they are doing, that is known as contribution. The regular payment, like regular members, is a revenue for these not-for-profit organizations. Let's do this example. NHN offers a regular membership of $10 and sustaining membership of $50 and over. So regular membership is 10 and the sustaining means the premium membership is $50. All members are entitled to the same newsletter and the same local discount coupons that are distributed when the dues are received. So nothing special is given to these special members. But why they will buy expensive? Because they know that this organization is a profit-making organization, not for profit-making organization, and they want to serve the community. That's why they will be giving more. NHN receives 500 regular memberships. So when they get 500 regular memberships, each membership is for 10. So the total money they receive from regular is 5,000. And 130 sustaining memberships per head cost is 500 multiplied by 130, 6,500 money they have collected. But I cannot record it together. I need to divide this 50 into two parts. For 10 is the regular and the 40 is extra, right? So this 10 out of 50 is going to be classified as contribution, as a revenue because they sell the memberships, and this extra is a contribution. Okay, so let's do this. Cash gets debit. How much cash? The total, these two cash they have collected 11,500. Revenue is from the sale of membership. So 500 regular membership they sell, and 130 membership sustaining they sell, who also paid 10. Right? So together we have 630 memberships multiplied by 10. So 6,300 is the revenue they receive from the sale of membership. And the extra they get from 130 sustaining membership, that was 40. That's a contribution, 5,200. Donated securities and investment income. Sometimes some donors they do the investment for these not-for-profit organizations, and return on those investments are utilized for the social work. So NHN receives securities, means some investments, fair value is 5,000, with a stipulation, means with a restriction, that they permanently endow a park enhancement project. Means permanent restriction is on them, that they should be used for the park enhancements project. Income earned on these securities is restricted to use for the park project. Now these investments have earned a dividend of 475, that is supposed to be used. So firstly, securities are assets 5,000, and they have permanently restricted contribution 5,000. Then they get the dividend income, so cash gets debit 475, and this cash has a temporary restriction for the purpose, so that's 475. It should be used for park enhancement. They have not used it yet, so this is temporary restriction revenue for the investment income. When it will be used, then it will move from temporary restricted to the unrestricted. Let's talk about supplies. NHN supplies on hand 1,600 at January 1st. The organization purchased supplies for $1,500 during the year, and receives donation of supplies that had a fair value of 2,050 in addition to 390 already received. So they are telling us different, information, that they purchase some supplies and they get some supplies as donation. At the end of 2016, the inventory on hand was 750. So see, we have opening inventory of supplies. They purchase supplies, they get donation of supplies, but at the end it's only 750. It means that remaining is used. Right? So where it is used, they're telling us the supply used were allocated to recreational program 2000. So this is an expense, recreational program. Then community service program 1,400. This is also an expense they did. Fundraising expense for 600, and management and journal expenses were 790. So this is how they have used these supplies. So let's record the journal entry. Firstly, the getting of supplies and then their use. So material and supplies inventory gets debit. How come? 1,500 they purchase, so cash gets credit, plus 2,050 they get a contribution, and there was no restriction on their use, right? So unrestricted contribution. So together the new material and supplies inventory is 3,550. Don't forget we have opening as well, 1,600. Okay, now we have used it, so the expenses are written over here. Supporting services expense 750, then recreational programs, then community services, then fund services. All these expenses we have recorded with their value, and we have credited material and supplies. Let's talk about donated services and the payments of salaries. An accounting firm donated its services to audit the books of NHN. Now, accounting firms also do donations, but they do the donations of services. They provide their services free of cost. The audit would have cost the association 1,200. This is the cost for this audit firm. If the services have not been donated, like if they have not given the donation, then this amount they would have earned. But because it's a donation, that's why they did not earn this amount. They have donated it. NHN also paid salaries and allocated to the program services and supporting services as follows. They have recreational program services 6,000, community services 4,000, management and journal salaries 1,500, and fundraising services. So firstly, we need to record, these expenses. First expense for this NHN is the audit expense. So expense gets debit, which is you can say audit expense or manager and journal expense 1,200. It's an expense for NHN. Though they didn't pay it, they get a contribution or donation service against it 1,200. Now they also record their other expenses. For other expenses, they cannot club together because they have to pay cash for them. So all the expenses, they pay the cash. So cash gets credit. This recording is actually payment on cash. The previous recording for the expenses was decrease in supplies, where the supplies inventory was used. Moving on towards the depreciation. Equipment owned by NHN is used to travel through the neighborhood and provide park programs, different programs they arrange in the parks. There are no explicit or implicit donor imposed restrictions on these fixed assets. There are no restriction on these fixed assets which they have. So the equipment has been recorded as an unrestricted asset. It's already being recorded. The organization allocated the 8,000 depreciation expense on in equipment to its program services and supporting services as follows. Now we need to tell you that why they are recording the depreciation on this asset. So accumulated depreciation they are recording as 800. In the question it's written that 300 asset gets 3,000 asset gets depreciated because of recreational program. Asset gets depreciated 4,000 because of community service program. It gets depreciated because of the management and journal services $1,000. So students, we have to specify which program because of which program the asset got depreciated and how much. So instead of writing one expense, we have to write program wise, and of course these values should be provided to you, and accumulated depreciation gets credit. Last but not the least, fixed assets purchased with restricted resources. NHN purchased equipment costing 4,000. The equipment was financed by 3,000 from contribution with donors imposed restrictions that was accumulated for the purchase of equipment, and 1,000 from the journal sources. So when they purchase the equipment gets debit and they credited the cash. But if you remember, out of this cash, 3,000 is the donor given cash as a contribution which organization already have. Now it was temporarily restricted. Now it's out from temporary restricted and it's in unrestricted. So that's why temporary restricted net assets gets debit. Reclassification out. We are taking it out from there and we are putting it in the unrestricted net assets. This is it about chapter number 22. I expect everyone to watch this lecture and come prepared for the questions in the next week classes, because we will have a quick review of these things based on your questions. Take care everyone. Have a nice day.